Have you ever wondered what would happen if businesses could see risk before it hits? If a bank could tell which customers will default months early? Or if a company could spot a cash flow crisis while everything still looks fine on paper? Most people think predictive risk analytics is something only big banks and hedge funds can afford. But the truth is, it was built to solve a very practical problem. Modern financial damage happens too fast for humans to react in time. To see this clearly, imagine something simple. Your bank texts you instantly. Unusual transaction detected. Was this you? That alert didn't come from someone manually watching your account. Without realizing it, you've already experienced predictive risk analytics, pattern detection, predicting risk before the loss happens. This is the Learning Studio, where we turn future finance into clear, usable thinking. What's actually happening in that moment is straightforward. The system compares real-time behavior to historical patterns, scores the risk, and flags what looks abnormal. Predictive risk analytics is simply the use of data models and AI to estimate the probability of future loss, default risk, fraud risk, liquidity risk, market risk, so action can be taken before impact. At scale, this becomes a financial radar. Banks predict loan defaults by learning from repayment history, spending behavior, income stability, and broader economic signals. Insurers detect suspicious claims patterns before payouts. Audit teams flag unusual journal entries before statements are finalized. Companies forecast cash shortages before suppliers go unpaid. Even markets are monitored for instability signals that hint at volatility spikes. The big shift is philosophical. Old risk management asks, what went wrong? Predictive risk asks, what might go wrong next, and how do we block it? That's why it's more valuable than traditional reporting. Reporting tells you the crash happened. Prediction gives you a chance to avoid it. This field didn't emerge from finance alone. Its modern foundations were shaped by statistical decision theory and machine learning, especially ideas formalized by Thomas Bayes, whose work on probability under uncertainty became central to risk scoring and predictive reasoning. Finance later scaled these ideas using big data, computing power, and real-time transaction systems, turning uncertainty into measurable probabilities. But here's the part most people ignore. Prediction is only as good as the data and governance behind it. Bad data creates bad forecasts. Biased inputs create biased outcomes. Overtrusting models creates false confidence. That's why predictive systems don't replace human responsibility. They raise the standard of it. The best professionals don't believe models. They challenge them, test them, and use them as decision support. Once you understand this intuition, risk stops being a surprise. It becomes something you can monitor, score, and manage proactively, like weather. Except the storm is financial. Now that you understand predictive risk analytics, the next natural step is to explore autonomous financial decision systems, where AI doesn't just warn you about, but starts making financial decisions automatically. Stay curious, stay sharp, and keep learning with the Learning Studio, where modern finance is explained the way it really works.